So, hi everyone. I'm here with Andy Johnson today. He's a client partner at Foremost, and Foremost are, a credit risk consultancy firm doing a lot of analytics. So, Andy, thanks very much for joining me.
Thanks very much for asking me. You're welcome.
So, this conversation kicked off really around we're talking about like emerging risks and trends in terms of affordability. And I know that was a paper that you've written. Very interesting in terms of some of the new data sources you've got, etc. But what are some of the trends you're seeing being at the coalface and some seeing what expenditures coming through in terms of affordability, those kind of things? What trends have you been seeing over the last sort of 3 months or so?
Yeah, everything, the genesis for this was really the cost of living crisis, where we've seen a bit of a sea change in a lot of expenditure patterns and how people manage their monthly budget. So the obvious ones that come to the fore are a significant change in energy spend, which we've seen particularly over the last 12 months. In the last three, as you go into the colder months, you start seeing increases in energy spend, particularly in the lower income households, which people perhaps don't expect. And then the other one was obviously food expenditure, where you would expect to see a significant increase in spend, but actually for households at the breadline lower income levels, there's clear evidence that people manage to a budget as long as that budget is maintainable and we don't see continued increases, then we believe that the budget on food is largely sustainable.
So the cost of living crisis has been going on for a couple of years now. So this inflation that's happened. Are you seeing that moderating now a little bit? Inflation's still going up. You've still got positive inflation. Prices are still going up as a result of it, even if the rate is going down. How have you seen that kind of change? Because it feels like it's gone out of the news cycle a little bit. But what are you seeing, I suppose, from the actual data? You actually look at the data in terms of how that's actually impacting. Is it still impacting, or is it moderating a bit? And now it's just energy, as you say.
It's still impacting. The key point you make there, Chris, is absolutely right, is that the cost of living crisis, okay, the peak of inflation has subsided.
Mm,
However, we are still above the target level that is
mm,
set. Inflation is still above 2%. And what we find when we look at the most granular data is the inflationary effects impact lower income households disproportionately to the higher income. So, for example, the article that we published a few months back was looking at food spend, whereby higher income families were able to pare back their expenditure. So they were spending less on food, groceries. However, the lower income were not able to pare back any further. Therefore, they get a disproportionate inflationary impact because they were already buying essential levels rather than the more luxury items that others can pare back on.
Yeah, and is that just a question of almost like resiliency or like headroom within your affordability in terms of like how much you can do it? So if you're running a much sort of tighter budget, then you don't have that resiliency or sort of like headroom within the budget to be able to eke into it to a certain extent, whereas other people can cut back on luxury things. Is it really just limited by that?
I think so. I think people on larger incomes have decisions they can make that
Mm,
those on more moderate incomes cannot. So they can change the supermarket they go to. They can pare back on what they put in their basket. Those people who have really suffered throughout the cost of living crisis and receiving interest rate increases on their debt as well, they cannot make those decisions. They are already basically buying very basic food items and cannot really reduce those any further.
yeah. I mean, I was thinking the other day about how quickly you get used to the higher prices. It was actually a conversation earlier in the week, and we were sort of how like what you might spend for lunch or what you might spend on shopping or whatever it is, and you quickly get used to like this is the new level, right? But that is the reality, which is going to be the level going forward. I can't see prices necessarily coming down, maybe with the exception of energy. Energy potentially could down. Go down? What's your view on that? Is there anything going to go down, or is it still everything's going to stay at this level and carrying on going up?
Again, the peak of energy has subsided. Obviously, going
Mm,
back to the Ukrainian crisis, that was the peak in terms of gas prices. But if you look at the Ofgem cap that is imposed, the last two quarters have both signalled an increase. So if you look at what the future prices are for energy supply, it's actually on the increase. Whether we get back to the peak of the impact that the whole reason why the Ofgem cap was imposed, I don't know whether that's the case, but I don't think we're going to go back to the types of unit prices that we were getting when we were going through lockdown, COVID.
mm.
So that time there seems to be a bit of a sea change in the cost of energy generally.
I mean, the other thing that seems to be taking place is it's not just one sector necessarily. So we talked about food or energy as an example, but it's starting to flow through to all of the other sectors as well. So water has been in the news recently in terms of increases in tariffs in water with new pricing coming out. But all of that kind of adds up, doesn't it? So it has a multiplier effect in terms of the 20% becomes 20% on everything rather than just being in one location, which then makes it smaller across the whole of all of your spend. How much do you think that is almost like it just starting to flow through over time, and how much more have you got to go? Because that doesn't take any pressure away, it adds more pressure on, it feels like.
I think it's a great point. So if you look at individual categories of expenditure, you don't think it's significant. A mobile phone goes up £10 a month. Your
Mm.
public transport, travelling to and from work, has gone up very moderately, really. Cost of clothing again. But if you add all these things together, the cumulative effort could be £100 or £200 a month. And for those people who are on the lower levels of income, that's going to place real pressure on headroom to buy the basic essentials,
Yeah.
which in themselves are still going up.
And one of the conversations we had over the last year or so was almost like, where does that line, you look about income cohorts as an example, does the line of like where people are like getting stretched in terms of affordability, and has that been moving up into higher and higher cohorts? If you look at deciles as an example, it started, let's say, at like 30%, is that moving up to 40%? It's almost like this creeping kind of stretch of whether people can afford things is almost like creeping up into like higher and higher deciles. Do you still see that kind of behavior going? Is that something you track?
There's a very small increase into the higher decimals, but in reality, wage increases have, to a certain extent, offset. Clearly, their wage increases did not reflect the 10 or 11% CPI level that we saw 18 months or so ago. But the average wage increase has differed. In the private sector, it's closer to 6%. In the public sector, it's a little lower than that, at around 4. So it is addressing some of it. But again, at the lower levels of income, it is having a disproportionate effect because 6% or 4% is actually lower than the real inflationary effects that these people have seen on their essential spend items.
I suppose particularly wages and salaries, they can often lag in terms of like increases. So you see the expenditure go up, and then it takes a year or 2 years. It takes a while for that to sort of flow through the pipeline in terms of companies actually wanting to spend as much as that being able to as well.
Yeah, I think that's fair. And companies have suffered. They've been impacted by a national insurance increase as
Mm.
well. So I think the tendency when reviewing salary increments to reflect cost of living would tend towards the more recent trends than those
Mm.
that we saw 12, 18 months ago.
Is that kind of a measure looking at, I suppose, almost like the squeeze between almost like wage inflation and then I suppose expense inflation, and just whether that's getting narrower and narrower, because that's reducing overall, say, as you say, almost overall headroom, isn't it, to a certain extent? And whether that's, as a nation, is that decreasing for us overall? And then you can look at it at a cohort basis. Is that a valid measure worth looking at when you're looking at modelling particularly?
I actually think it's when looking at modeling affordability, it's one of the most poignant aspects because if we go back to pre-cost of living crisis, when securing credit, you could get a very low mortgage interest rate, perhaps
Mm.
2% fixed for 2 to 5 years, and your affordability actually was stressed at the standard variable rate, which was more like 5 or 6%, plus a further buffer on top of that. So if you think the stress that was applied to people's incomes and roll forward to now, interest rates are about 4 or 5%. There is no stress or a very moderate, maybe 1% stress applied to that. So the actual buffer between the real cost of credit plus your expenditure, less your income, is so much narrower now. And we think it's why understanding affordability and expenditure in a model sense when making credit decisions is such an important aspect of the consumer journey now.
Yeah, no, I know you guys have done quite a bit of work around like getting more recent information. I suppose recency of information becomes important, right? Doesn't, because a lot of the data tends to be quite historic, and the data I have access to typically is ONS data. It looks a little bit, it's a little bit lagged because they do the data gathering, the cleansing, making sure it's right before they publish it, and sort of tend to see it down the road. I know you've done quite a bit of work around looking at recency of data, as I say. So, like, how can you do that, and how important is that to really understanding, particularly in such a fast-moving kind of environment we've got at the moment?
Yeah, I think it's probably worth explaining. So the typical approach for many lenders is, as you referenced, is to use ONS data and
Mm.
lifestyle survey data. So that's a really useful survey. It gives you good information, but it's collected and published typically a year, yeah, in arrears. So the most recent publication by the ONS was published in August of last
Mm.
year. it was delayed because of the moratorium for the general election. It's actually survey data collected up to March 2023. So if we look back to then, cast forward to now, things are significantly different, perhaps less volatile, but still a different situation with further inflationary increases on top. So the data we use, which we collect from a company who we partner with called IE Hub, is information, I&E data collected from consumers referred to them by their creditors, and we update that on a monthly basis. So we have information now right up to the end of December. This time next week, we will have the data right up to the end of January 2025. So we can see the recent trends coming through. With it being updated monthly as opposed to annually, you can see the trends, the seasonal trends across the course of the year as well, which enables lenders to perhaps predict what their likely impacts would be. For example, energy bills. Are you going to see a disproportionate effect as a result of increased energy costs and usage over the winter months?
Yeah. And within that data, you have different elements of the affordability process. You have affordability process in the onboarding element in credit granting, and then you have affordability in the collections process as well, looking at affordability of loans if people fall into arrears. Where does the data come from? And I suppose, how do you make sure you're like being able to use that sort of independently? Because you can get skews as well. So you're going to get skews like, for example, a particular type of lender will have a particular type of customer, and that might lead to a certain different private profile to one that, say, for example, is in arrears and those kind of things. So like, how do you try to like extract the data to then look at some of those underlying trends? Because it sounds like the data's there, but you can get these biases. You've got to be quite careful, I'd imagine.
Yeah, I think it's important to understand and appreciate and accept the data we receive from IE Hub. These are customers who are either in financial difficulties already or anticipate financial difficulties in the near future. So the data we get are people who have already had to make adjustments to pare back their levels of expenditure to what would be basic essential levels, or in regulatory speak, non-discretionary areas of expenditure. So we think this is the best point to start for a really good and granular understanding of household expenditure. Thereafter, in terms of good customer outcomes, treating customers fairly, and understanding granular household differences, firms can then use this as the bottom level expenditure guardrail and increment the spend to give their customers what they believe is a good quality of life over and above.
And if you're looking at inflation at individual sectors, for example, the food sector, that you can extrapolate that to other income deciles, as an example, or other areas maybe people aren't financially difficult, and it's much more recent than something that's from 2003, as an example. So you've got that recency. Even that can be extrapolated over a wider portfolio, I'd imagine.
Yeah, absolutely. The beauty of this data is it contrasts with ONS, where you do get decile
Mm.
level data. This is collected at household level and could be aggregated up by income bands, by household composition, single, joint, multiple dependents, single dependents. We can actually take the data and aggregate up to group levels, which for new customer decisions is clearly a good thing because you are making the decision whether to lend or not and how much the customer can afford. But it also enables you to understand the customers that are already on your book and how
Mm.
their expenditure might have changed since you last had a contact point with them.
And when you look at the data, you talked about wage inflation, you always talked about, I suppose, expenditure. I mean, do you see like regional differences, but also, I suppose, things like employment or previous employment kind of trends? Because you've got quite a very like immediate kind of view on the economy to a certain extent. What's happening, for example, are there particular industries or sectors or geographical areas that are suffering or doing better than others? Do you get down to that kind of level?
We can. So we do look at things regionally. There's not an awful lot of difference across the regions. Incomes tend to differ across the regions because the cost of living differs across those regions. It's more expensive to live in and around London, for example, than where I live in the northeast. So income levels tend to differ proportionately to the expenditure. So there are aspects of that. Some of the things that we do see in the trend that perhaps are more related to climate type
Mm.
information as well, and the housing stock in various areas. So
Mm.
what you would typically see is the gas and electricity expenditure across the country, the blend between the two differs. Those in the north tend to spend more on gas. Those in the southeast and southwest spend more on electricity. Northern Ireland is a particular outlier because they have a lot of different LPG type households as well. So the regional trends aren't as pronounced as people might expect, but with climate risk becoming more to the fore, and obviously affordability for lenders making decisions often includes the energy efficiency of the property they are proposing to buy, we think it's going to become increasingly important.
Yeah, it's quite interesting looking at that level of granularity around affordability, isn't it? In terms of almost like being able to analyze that down to individual regions, individual households, household construct, those kind of things, which is much, much wider than a much kind of like broader approach to a certain extent.
I think in terms of getting a more granular, segmented understanding of your customer segments, the best way to do it is to have granular data and aggregate up rather than having the top level data and having to disaggregate down by making assumptions.
Yeah. And when you look forward in terms of like outlook, and I know you do modeling work and there's reserve adequacy kind of work and those kind of things, what's your kind of view around like where we're going from an economic point of view? Because there's been so much change even since 2023, right? I just think about even how the UK's changed structurally, and we have these large changes that come through, one of which is change of government. We've had a budget, we've had all these sort of things that are coming through. How do you take that into account? And I suppose what's your kind of what's the outlook of where we're sitting now? Because recent data is probably the best way of looking at it and getting an understanding of it. But yeah, looking your crystal ball a bit.
Yeah, I think historically in the financial sector, the crystal ball hasn't worked very well. All financial downturns are different. The drivers are different, but when you look at the loss emergence, the shape of the curve is always roughly the same. I think the key point is understanding precisely where you are now, what your customers look like now, what the affordability within there is, what their credit risk looks like, and thereafter having a very accurate starting point and stress testing according to various scenarios gives you a better understanding of the range of outcomes going forward. If the starting point isn't accurate, if it's generalized and on average, then actually the impacted segments in a future downturn are not going to be fully caught in your modeling techniques.
Yeah, it does feel like we've gone from, I remember 20 years ago when everything just seemed so stable, and it was sort of previous history was very much a predictor of the future. And even at an aggregated level, when we used to do it at an aggregated level, it just seems like in the last sort of like, particularly since COVID, everything's gone down to that much more like more detailed level, and the mix has changed. So that mix change has made those previous predictions almost not as predictive as they have been. And you've got to get down to that sort of detailed level to really understand what's going on. It's the only way to do it.
I think that's fair. I would argue that things were pretty stable in 2006,
Yeah.
and then well, look what happened, and then the cost of living crisis born out of something else. But
Yeah.
again, the impact still come through. What I would say is the financial sector is more stable now. It is better. It has better levels of capital born out of Basel 3 and 3.1 to come. So there is a more stable starting point. But in terms of estimating your expected losses, and that feeds into pricing, good value for customers, and all of those other things that basically give value to the customers and shareholders alike and balance out. If you understand those better, you can make better decisions for all.
I mean, one of the changes we had, I'm just go back to the pandemic. We try not to mention the pandemic these days, but going back to that in terms of like how much that actually changed some of the fundamental values, for example, household expenditure or incomes or those kind of things. And that's like a lot of that sort of based in the data. So you look at financial life survey as an example or expenditure survey, it changed almost like our lifestyles fundamentally for certainly for a year or 2 years, but arguably even longer. Do you think we're through that? Do you see that in the data? And I suppose that affects how you then lend money as well. Do you think we're through that in terms of understanding that, and then now it's much more stable, as you say?
There are, in the data we use, the granular monthly data, there are some clear sea changes that we don't believe will ever return. So, to give some examples, hybrid working patterns. We don't spend as much on clothing as we used to. Very few people spend 5 days in the office. The use of shirts and ties and suits is less prevalent. Of course, there are essential items for households with children, like school uniform. That prevails. But in terms of going to work, moving aside from clothing, if you think about household vehicles. There's a lot less households now have multiple vehicles. Since lockdown, people have tended to dispose of the additional car and they share. That is far more prevalent. From what we see in our data, the families who have gone through this IE hub process, less than 10% of those households have two cars. That was more like 35% prior to lockdown. And again, if you don't go into the office 5 days a week and you use public transport, your public transport costs have gone down significantly.
And I suppose things like energy as well. So if you're at home, your energy use goes up, and we all know that. You're sitting there with the lights on and the computer on and potentially heating on as well, which is different than if you're in the office. And so there's a bit of a swap set there, isn't there, in terms of expenditure? But does it add up to being more affordable or less affordable is the big question.
Yeah, I think that. Do you spend more on energy from working at home than you spend on transport going to and from work? I would have said, depending on the distance you travel, I think there could be winners and losers in that equation. Net, it probably costs more to travel to and from work 5 days a week on public transport than it does to run your laptop and put the light on.
Yeah. And I suppose, do you think we're through that period of massive change and that's going to be more stable going forward, albeit with some changes that won't necessarily go away? But it's almost, are we into that? Because we're in almost, it's not like when you're in an airplane, you're in very like bumpy air and everything's changing at the same time. We have this massive sort of change that's going on. Or do you think we're in a sort of a period of smoother air now where we can get back into, from a lender point of view, more systematic lending, those kind of things? Or do you think we've still got more to go and there's more change that still need to work its way out?
And I would hope the volatility of the past few years is largely over. But again, what it has done is it's put us into a generally higher expenditure environment that's unlikely to return. If we think about the low expenditure environment, the low interest rates and low inflationary, that was largely as a result of measures imposed as a result of the global financial crisis. They have unwound, and the general approach of the Bank of England now is not to have the interest rates at such a low level. They're probably back towards where they are back towards what is more a long run average rate. But that long run average comes alongside a higher cost in terms of expenditure. So I would hope it's smoother, but the general point I would make is it's smoother, but it's higher than it was perhaps for the last 15 to 20 years.
I mean, the interesting piece from a almost like from a psychology point of view is we sort of we're in this world where we expect everything to happen very quickly, and so we expect sort of like we're watching the media and like this policy's been changed, and so therefore we're gonna have this result, we have this result by the end of the year. But actually, some of these things take a long time to work through the system, and there's almost like a natural sort of like timing of these things or period of these things. So you're talking about 2008, as example. We're still talking about 2008. It's 2025, and we're still feeling the effects of it, and it's flowed through to a certain extent. We've got to have this understanding around longer term effects in terms of like how they impact the economics, but also the lending kind of market as well.
Yeah, I think that's fair. I think in the days of cheap credit, unsecured revolving credit was very cheap, typically an interest-free deal followed by a variable rate after that. So the use of unsecured credit, the use of cards and revolving buy now, pay later, all of these things have become an accepted way of life. The reality is now credit card limits are still going up, credit card spend still going up. It is more expensive. Households need to be responsible and lenders need to be responsible to make sure that doesn't create the next bubble, because we always say this thing's never happened. Most of the things in the past never happened before, but when they happen very quickly and it creates a shock.
And I suppose the key to that is recency of data, coming back to the point earlier, in a sense like making sure you're understanding what's happening now, because the sooner you get access to that data, the sooner you can react to it and have that
Yeah.
sort of like foresight to a certain extent.
Absolutely. So lenders have got their own internal data. They know how their portfolios are performing. They know how they're managing credit limits. They know how their customers are spending in terms of the credit commitment with them. What this kind of data gives them is an outside view of, and what do those households' general expenditure levels look like that you perhaps can't pick up from the products that those customers have with you.
Well, I mean, the whole thing's super interesting. I mean, I suppose if I put you on the spot in terms of what are the top three things or the top three risks you think we've got to look out for the rest of this year, as an example, from an affordability point of view, where do you think is the areas where you've got clients sort of like this is worth keeping tabs on?
I think I would look again, just going back to the point I've just made, the customer bases that we have, there are processes in place up front, decisioning systems that all lenders have, where there's an assessment made of what can someone afford and what is a good outcome. I think by and large, those processes are robust, and if anything, they err on the side of prudence.
Mm,
However, what they do is a lot of the processes are based upon ONS type data, which looks at the average household. The risk I see in doing that is I still think there are pressures at the lower income levels, perhaps households with multiple children, where the cost is disproportionate to those on higher incomes, and perhaps where the children have grown up and left home. I see a pressure point in those areas, and giving credit to those households that is not fully understood,
mm,
both at the decision point and thereafter. Because what we always forget is once a bank has loaned the money to someone, we have very few touch points with
mm,
those customers unless there's a problem.
mm, mm.
And I
Yeah,
think it's
so
it's being preemptive rather than reactive to
yeah.
those type of events.
So it sounds like watching sort of like watch this space in terms of how inflation continues or moderates a little bit, what happens in terms of wage inflation, but then also then that's almost that again, it's that borderline, isn't it, around like families, people with children, maybe who might not fall into it, what we would typically think as being financially stretched, but actually have got very stretched budgets at the moment because they've got less of that headroom going on, and so that's an area like where there's that sort of sensitivity to watch about it and getting that insight.
Yeah, I think so. The decisions at the margin now is would be my point number one. Number
Mm,
two would be have a view towards what could happen in the next 12 months. It looks largely positive in terms of interest rates are expected to fall a little. Inflation is becoming certainly flatter, largely under control. It's perhaps have a view to not exacerbating that with increasing lines to people who perhaps can't afford them.
yeah. Andy, thanks very much for the insight. I really appreciate it. I love the whole idea around like the recency of information, getting a handle around what's actually happening. I mean, I always felt that that's a great place where we sit in the industry is really having the handle on what's happening today rather than what happened 6 months ago. So it's so some of the insights you've got are fantastic. So really appreciate you sharing them, and it's fascinating to chat to you. So thanks very much.
Hope I enjoyed it. Thanks for your time.
Thanks.
Cheers, Chris.